Holy smokes, everyone. We need to talk about what Jerome Powell just said, what the Federal Reserve just did, because people, this is huge. We have some huge announcements. We're going to get into exactly what he said and exactly what everybody's getting wrong. So everyone, let's not waste any time. Let's get straight into it. All right, look at this, everyone. It is official. What nobody thought would happen in 2022. The Fed lifts rates a quarter point and signals more rate hikes coming. So borrowing costs seen rising at each month remaining in 2022. Now this is big, everyone. Remember at the start of 2022 when the Federal Reserve admitted that inflation was wrong, but they said, don't worry, we'll only do 3 to 4 rate hikes. Well, now guess what? The Federal Reserve has says they're going to be hiking at every single meeting for the remaining of the year. They're going to be doing 7 rate hikes this year, bringing the federal funds rate up to a range of 1.9%. And this is exactly what I've been saying, everyone. I was saying there's no way they're going to do 3 or 4 interest rate hikes. That's going to do nothing to stop inflation. But also, again, which I'll get into later in the video, these 7 rate hikes still aren't going to be enough to stop this inflation. And of course, Powell says the economy is very strong and can handle tighter monetary policy. Now, if you think with the latest Federal Reserve decision in the markets, they're at the bottom in the markets right now, and they're going to go up to all-time highs. Well, Moomoo is doing a special promotion right now where you can get 3 free stocks with depositing any amount. You can literally just deposit $1 and get up to 3 free stocks and also a guaranteed free stock of NEO. I'll put a link in the description and in a pinned comment. Again, people, like I always say, these central banks are always going to talk positive about the economy and about the markets. It's their job to do that. But his words and their new economic projections say another thing. Because today we also got the Federal Reserve's economic projections as well. And many people before were saying that the economy was going to grow at 4% this year. But now the Federal Reserve has slashed that dramatically to just 2.8%. Now, they said the reason for this is obviously the situation in Ukraine right now, skyrocketing commodity prices and higher oil prices. So I think, again, they're going to be missing the mark here. I think we're going to see much lower GDP growth. And like many people predicting, and I'm predicting, I think we're actually going to enter recession in 2022. And even if we do have economic growth of, say, 2%, remember, people, inflation is 8%. For the real American, it feels like we're actually in a recession because your wages are not keeping up with inflation, because costs are skyrocketing, and your standard of living is declining month after month. So whether we enter a technical recession or not, for the average Joe and Jane, it already does feel like recession. But something even bigger than the federal funds rate right now that we have to talk about is the Federal Reserve's balance sheet, their $9 trillion balance sheet. Now again, December 2021 last year, this was what really spooked the markets when the Federal Reserve said they're going to start selling off some of the assets. Because you can literally put up a chart of the S&P 500 and the Federal Reserve balance sheet, and you see how correlated it is. When central banks are printing money, when they start purchasing assets like US Treasuries and mortgage-backed securities, the markets love it. But like I said, the Federal Reserve hinted that they're going to start reducing their balance sheet this year, but in this meeting they haven't given us an exact date, but they were hinting that they're going to start doing this in May. Now also, what we don't have as well is we don't have how quick they will taper their balance sheet. Will they sell $50 billion, $100 billion worth of assets each month? Many people are betting on $100 billion per month, and I'm betting on that as well. And the reason why this could be even worse for the markets than the Federal Reserve actually lifting the federal funds rate is when they lift the federal funds rate, it doesn't always mean that the 10-year US Treasury is going to go up 25 basis points. But if they do start dumping bonds and all of a sudden bond prices collapse, then that means yields are going to skyrocket. And that means borrowing costs are going to go up, credit card rates are going to go up, mortgages are going to go up, and that has a big effect on economic growth. It also has a big effect on margin debt, which is bad for the stock market because we all know margin debt is at record levels right now. Now, of course, the markets love this news today. The Dow up 500 points, S&P up 2.2%, and the Nasdaq up 3.7%. And we can see the 10-year US Treasury yield is almost at 2.2% now. But what I do find interesting is the dollar actually sold off today, maybe from some of those weak economic projections. Now, again, people, we can see here how the Federal Reserve has been expanding their balance sheet rapidly, and they have a long way to go to get it back to what it was normally in 2017. They have about $4 trillion worth of assets that they could dump, and if they do dump all of these $4 trillion in assets, this will be very bad news for the market. So this is really the next risk I'm looking at for the markets right now. So you're probably wondering, okay, why are the markets rallying so much right now? Well, people, because this was pretty much in line with expectations, the markets were worried that the Federal Reserve may do a half a percentage point rate hike, and that's really what they should have done. And even lifting interest rates to 2% this year won't stop inflation. And this is the big lie and the big scam the Federal Reserve is doing. They're saying, oh, you know what? Okay, we've got skyrocketing inflation. So you know what we'll do? Okay, yeah, we'll lift interest rates 0.25% and bring our rates up to 2%. That'll really stop this 8% inflation. No, people, look at this. Look at this, people. This is the chart of the Federal Reserve's fund rate. Now, we can see here the last rate hike cycle that they begun in 2016. They started lifting interest rates 2016 to 0.25, 0.5, and they bring interest rates all the way up to 2.4 to 2.5% in February 2019. Now, I don't know if you remember, but inflation was very low in 2019. There was no high inflation, but the Federal Reserve lifted interest rates to 2.25 to 2.5%. And do you know why they did that? Because that's just part of normalizing monetary policy. The Federal Reserve was going to bring interest rates up to 2% regardless of what happened to inflation, if inflation was high or not. And this is why I think the markets are loving this news right now, because the markets know if the Federal Reserve was really serious about fighting inflation, they would need to bring interest rates all the way up to at least minimum 5%. Because think of it like this: if you have your money in a bank account and you're getting 3% interest and inflation is 8%, what are you going to do? Are you going to keep that money in the bank and earn 3% interest, or are you going to take that money and invest it in the markets? Well, of course, you got no choice. The Federal Reserve is giving something called TINA. There is no other alternative but to put your money in the markets, because inflation is going to erode your purchasing power. So people, what you're probably wanting to know is, okay, what does all this economic jargon mean for me in simple terms? What this means is what happened with the Federal Reserve meeting today was broadly in line with expectations. So that's why we're seeing no reaction in the markets right now. But what the Federal Reserve is doing by lifting interest rates up to 2% this year is not going to be enough to stop inflation. And I think there still is room for more rate hikes, of maybe a half a percentage point rate hike this year by the Federal Reserve to bring interest rates possibly up to 3% if inflation doesn't go away. And if we look at the chart here, the markets don't actually crash when the Federal Reserve starts lifting interest rates, because it takes a while for these higher rates to flow into the economy. What we saw during the last rate hike cycle is the market started crashing around 20% at 2018 when interest rates went over 2%. Because again, it takes a while for us to get the data to see how these high interest rates are affecting the economy and affecting lending. And when interest rates hit 2% towards the end of the year, that's when we're going to start to see some real pain in the housing market as well. So everyone, that's just a quick update with what the Federal Reserve just said. Now, if you're interested and want to join the channel and get access to private live stream and Q&As, I'll put a link in the description in the comment section. Also, if you want to get up to 5 free stocks with Moomoo, and you can actually get 3 stocks with just depositing any amount. You can literally deposit $1 and get up to 3 stocks. I'll put a link in the description as well. Thanks for watching. You're awesome. I'll see you in the next video.